Hello to all traders. Happy New Year. If didn't have the chance to say that yet, so I want to welcome to you in this monthly engagement again for the U.S. non-farm payrolls. Today is Friday, the 10th of January, and we are expecting December's NFP data, which is the last data for last year. Now starting, of course, I want to go for the risk disclaimer first, and then we're going to go quickly have a look what we're going to explore for today's live webinar. Forex exchange trading and investment in derivatives can be highly speculative and may result in loss as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. This webinar is provided for information purposes only. No information contained herein constitutes a solicitation for the purpose of the purchase or sale of any commodity, security, or investment, nor should it serve as the basis for any investment decision. Orbex Limited does not guarantee the accuracy or completeness of any information or analysis supplied. On this slide, you are seeing, of course, my Twitter handle and also my LinkedIn handle. Feel free to connect with me. I am posting on a daily basis on social media, marketinsights, as well as other related posts. So you might find it useful to keep connected on that end. So today we are going to see take things on a certain order. Of course, we're going to see firstly the preview, the analysts' expectations, what economic indicators can help us with projections and why. We're going to do some sort of analysis on the fundamentals, okay, to get an idea of at least the data sentiment, what the data is showing and has been showing according, of course, to the latest releases. We're going to see different ways of choosing the best pair to trade for the NFP, of course, and how we can all protect our capital, because as you might as well know, the NFP is a very, very risky event, very volatile, and a lot of stop outs can be taken out in a matter of milliseconds, right? So with the first slide here, we are able to see the expectations for these non-farm payrolls. If you just give me 1 second, I'm just gonna take out the pen just to mark things while I'm going from one slide to the other. So analyst expectations are at 168,000 jobs, which is high, if you ask me. However, this is, of course, a decline from the last time, right? So last time we got 266,000 jobs, which is a very good number. And we're expecting again 168. This is the same forecast pretty much. So economists are not expecting to see much difference on the jobs added in these months, in December's pretty much NFP. However, note that the difference between those two, right, is 100K. This is the last month. Now that marks one of the best NFPs in quite a while, okay? Because we don't often see a divergence between the forecast and the actual number of 100K. Now, the thing is that December's NFP as well is affected by the Christmas season, right? Because a lot of people, there's a lot of positions that are being filled, and since the NFP is considered part-timers to be a job, to be added on the job, then there is good chances that this is going to be affecting the NFP numbers positively. Now, pay attention that, still the economists are expecting the same expansion as they did last month, okay, and this is 168K. Now, the December's release was the first positive, let's say, divergence to the expectations after 1, 2, 3, 4, as you can see here, consecutive misses in the expectation, right? Since August, and also the third best in 2019. And guess what? That follows February and also last January. Now, expectations for February and also January last year were 170K and 168 respectively, right? Which is the same number, coincidentally, is the same number as on this forecast. Now, as I said before, in 2019, January was the best month, and this is important to keep in mind for today's forecast, of course. Now, on the next slide, let's go a little bit further into what's happening with other blocks of data, namely the unemployment rate and, of course, the average hourly earnings on a month-to-month basis and also on a year-to-year basis. Now, the analyst expectations for unemployment are neutral at 3.5. In December, analysts beat expectations of 3.6. Unemployment rose or declined, if you may, to 3.5, right? Now, the hourly earnings are very, very critical as pressure on the Fed's guidance following the interest rate cuts, of course, over the past 6 months is mounting. Now, in the previous month, the hourly earnings were missed by 20 basis points, but there was a 20 points revision on the month before, okay? Now, wages on the yearly basis are still expected to be good, because as long as we're above 3% actually on a year-on-year basis, this is expected to be a good number. But we are expecting, again, analysts expect, not we are expecting, to go down from 3.1 to 3, okay? This hints, of course, to pessimistic inflation expectations. And on a low interest environment, this could be adding more pressure in general on the dollar. Now, the thing is that if we look at the CPI, core CPI inflation, right, not PCE, CPI, the latest data showed that this rose from 1.8 to 2.1%, beating expectations of 1.8%. Now, at the same time, it remains far from this ascending trend line, which is just an average, let's say, but it is above the 2% target that the Fed and any other central bank has set for on their mandate, okay, which is quite important. It's an inflation figure, CPI figure, that many didn't expect to see. So that can be considered as positive, I would say. Now, in terms of the preview, right, there is a certain piece of data that we need to look into to be able to form our own projection. There is lagging indicators and leading indicators. Lagging indicators are the ISM manufacturing and non-manufacturing, because business conditions in manufacturing and services sector signal an increase or a decrease in employment activity. The challenger job cuts and jobless claims, because they show information on layoffs and how many people claim for unemployment. The ADP non-farm employment report provides a monthly employment data in the private sector, but it's released by ADP. It only samples 60,000 eligible households compared to 643,000 when we're looking at the NFP. The other lagging indicator is the consumer confidence. That includes the University of Michigan sentiment and also the CBCCI. These two surveys are used to measure the behavioral mood and consumer optimism, okay? And they affect spending and also savings. So they are more related to business cycles and longer term sentiment, let's say. And of course, the leading indicators, which are the Treasury yields and the equities, as well as the crude oil prices. Now, Treasury yields and equities, when the yields are up, now market sentiment is bullish, okay? And this hints to markets participants projecting a good NFP. And the equities, of course, are positively correlated. Now, in terms of crude oil prices, when crude oil prices are up, the market expectations are somewhat positive again, as the boost in inflation raises the prospects for higher wages. At the same time, if there is a push in inflation, then the Fed should be looking to also increase in interest rates to control the inflation around the 2% target. So it's very natural that this is the case. Now, I've put together a table having listed all the indicators together, lagging and leading as well, right? So we can see what data are supporting a good NFP for the December release and what data are supporting a bad NFP, right? Now, taking each of those on an individual basis, the ISM non-manufacturing, which is pretty much all the services data, and it equates to around 80%, 70 to 80% of the non-employment of business activity, let's just say, came out at the 55 level, which is a very good level. It came out better than the forecast and also better than the previous figure. Now, the problem here is that the employment component of the ISM non-manufacturing came out at 55.2, which is a little bit lower than the previous, right? Now, pay attention to this. ISM manufacturing kept falling, okay? We are below the 50 level, right? We are still in a contractionary sort of period, let's just say, right? Not only the economists expected a rise from 48.1 to 49, but we also slipped much lower than the expectations and much lower than the previous figure of 47.2. Now, pay attention that ISM manufacturing is very, very, very well affected by trade war issues, right? So that is the main reason we see this being contracting for a few months now, actually. However, the case here is that, as I said before, it doesn't really, it does affect, but not as much as the ISM non-manufacturing does, because the services sector will have a relationship of 80 over 20 over here, right? So the non-manufacturing is way more important than the manufacturing. The employment component also fell here. It went to 45.1, which is a bit low, to be honest, far away from the 50 contractionary level. Before also below the previous figure of 46.6. Now, the job cuts, they came out quite good. Why? Because in the previous month, we saw around 44,000 actually jobs being cut, right? But in December, we only saw around 32,000, 33,000, which is a decline of around 11, 12,000 jobs, which is a very good indication that less people were laid off pretty much, okay? Now, jobless claims also increased, were positive, and this is of course expected since there were less people that lost their jobs. Jobless claims were also in the last week after, actually, right? They were good. They were like 9K below the forecast and also below the previous number as well, which is very good indication. The ADP came out good, okay? Came out at 202,000 jobs added. Now, of course, this is a sample that has a relationship of 1/10 compared to the NFP, because the NFP, we are actually sampling about 650,000 data. On the ADP case, it's around 60,000, right? So we've had, however, 160 forecasted, and 40,000 over that indication, that projection is not bad. I mean, over 50 would be much better, but still 40 is quite good. Now, if we take into consideration that the previous number was 125, we're talking about nearly an 80,000 increase on a month-to-month basis, right? Irregardless of the expectations. Now, consumer sentiment at 99.3, a tad higher than the previous, right? Than the forecasted, but below the previous. Pay attention to this, 96.8, 99.3. Sorry, no, 96. Is that 96? Yeah, it should be 96. Okay, it's actually much better, so ignore what I said. And the CB consumer confidence, again, came out, was unexpected, 128, 126.5, 126.8, also below the previous number. Core retail sales on a month-to-month basis also depreciated, went around 0.10 from 0.4 expected, and the previous number was 0.3. And last but not least, of course, let's have a look now at the leading indicators, which is Treasury Yields, equities, and crude oil. As of, I think it was probably less than an hour ago, we've seen the Treasury Yields being very close to the closing price, so I don't think this is going to be affected. It seems to suggest that markets at least are expecting a mixed, they're not sure pretty much, right? Now, equities are up and crude oil is up. However, if we take into consideration the rally that the equities markets have been over the past few days, then I'm not sure if I would take that into consideration today. Crude oil, it has a huge decline the other day, and it's pretty much, this is like a short recovery, to be honest, as well. So again, I'm not sure whether I'm going to pay attention much on the leading indicators this time. Now, however, we still have this table, and we still need to look what are the pros and what are the cons, right? So pros, we have 1, 2, 3, 4, 5, 6, 7, and cons, we have 1, 2, 3, 4, 5, 6. Not far one another from when comparing the two. So again, as you can see, sentiment can be, at least from the economic and fundamental perspective, on a macro perspective, can be a little bit mixed. Now, how can we identify what is the best pair to trade? We've gone through this before. We need to look, one of the ways is you need to look at the differentials between the banks. Of course, the Canadian one and the US one are the best one, the best case. Of course, if the United States, the NFP is good, we should be looking to trade that against the Swiss franc, against the Japanese yen, and against the euro. Okay. Now, if the NFP comes out worse than expected, then we should be looking at the dollar CAD sell-off, because Canada has high interest rates, and that will be the only one that is able to put up a fight against the strong yield-wise, right, strong dollar. The other method, of course, is to have a look at the currency strength meter. We see that the pound is quite strong, and this is probably like over the past few 30 minutes or so. The Aussie is quite strong, but at the same time, the dollar isn't doing bad itself, right? However, look at this. The Swiss franc and the yen are very, 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 very weak. Obviously, you cannot trade GBP, JPY on the NFP. You could if you wanted, but it's not really going to be the pair of my choice. But you could trade USD JPY and USD CHF, given, of course, the NFP comes out better than expected. Now, if it doesn't, it means that you could trade the GBP USD, okay? Which means, of course, the GBP USD is the one that has very good chances, according to the currency strength meter, to move up on a weakening of the USD because of the NFP. Now, of course, don't forget that we always need to protect our capital because it's very critical, a measure when considering that the NFP is very risky, highly volatile, and you could bust your account just out of one event. So, of course, the first thing to do if you're not really, if you not have mastered the markets, is to avoid trading completely. If you don't want to, then make sure you apply stop loss and take profits. Then again, if you have open positions, you could either close them to avoid risk, or you can hedge them, which is a little bit more complex, I would say. If you really want to trade, maybe it would be a good idea to let the markets calm down first and then, approach with a different eye, with a different perspective away from high volatility. And then again, as we've just done today, analyze the data post-release. We talked about the importance of the actual figures, the prints, okay? We need to look at the divergence between all of them, and we need, of course, to look at all the data. We need to look at the unemployment data. We need to look at the average earnings, because the first move that we're going to see in the markets will be the headline number, which is the jobs added. Then secondly, any whip shows or any sort of post-effectual bias will depend on all the data combined, okay, not just on the headline. So I will pay attention to the divergence as well between the actual and the consensus. And if any gaps are not like over 30, 40K, I wouldn't be really looking at the initial move to be a decisive one. Okay. Now, that being said, this is the end for the presentation. So we can go ahead, we can have a look at the charts. Okay. We do usually analyze on a daily basis using Elliott waves, but I want to tell you when it's time for the NFP, there is no reason to do that. Okay. When it's time for the NFP, we need really to look at support and resistance levels, high activity levels, because those are the ones that are going to be taken out first. Now, I want to increase my layout here. I want to do a 4 layout chart here and have the euro dollar. I want to have the dollar yen. Dollar yen. Okay. I want to have the dollar Swiss franc. Dollar Swiss franc. And also I want to have, is this dollar Swiss? Yes, dollar Swiss. On the 15 minutes, then we can change that on the 15 minutes. We are here on dollar yen, 15 minutes, which is good. And I want that to be the pound dollar. Okay. Let's get rid of those. And then again on the 15 minutes. Okay, we'll have like 7 minutes left for the results to come out. So what I want to do in this time is draw some support and resistance levels, right? They can be used as support resistance, okay? And of course, that coincidentally sequentially mean that this is could be used as a entry or an exit level, okay? So I'm not looking at the right of the chart, I'm just looking on the left, and I'm just drawing here lines or activity levels that are likely to be taken out. So to the top, this could be 110.96, could be potentially a move to the upside, an entry to the upside. On the downside, we could be looking at, I think we need to bring that a little bit further up. Yeah. Make sure that we're really looking at the market with a good eye, have a good view on this, right? So there we go. Euro dollar is ready. Dollar yen, we can draw one. On dollar yen, we are over here. We've got 3 levels drawn. I don't think we need more than that, to be honest, because we're very close to the 110. So in case we use that as an entry and we break over, then we're probably looking at 110 anyway. Okay, on the downside, let's draw that one as well. And we are ready to go here as well. Okay. There we go. That's it. Then dollar Swiss franc. One. It's you just need to take peaks and lows pretty much, right? That they are near the current price levels, and from those, the ones that they are nearest to the current price are usually the ones that are going to be used as entries. The ones that they are further away, and of course with a reasonable target, are the ones that are going to be the exit, right? So we've got those up here, and then on the downside we have 1, 2, where are we now? We're at 97.60, 98. Okay, don't forget the 98 as well. So let me just pull that a little bit. 9. Okay, that's actually okay here. So you can see how easily this can be done, right? It's not something that requires skill, to be honest. And then I want to look at the pound as well, because we said that in case the NFP comes out worse than expected, we can see that the pound is quite strong at the moment. It's falling as we speak, but it's irrelevant. It has been stronger against I mean, pretty much that is the currency strength meter that tells us that it is the strongest from all. So that is the main reason we want to trade longs. Okay, that's the same level. High activity over here. We don't want to go too low. Okay, and then another one on the top, probably over here. Okay, and again we'll have the 131 as well. So don't forget, when psychological levels are very close to the current price, then look at those orders to be cleared out first, okay? Because there is stop orders there, and there is normally very big orders, okay, on psychological levels. Now, especially the 131 over on the pound, the 130 on the downside is a bit far reach, to be honest. Now on yen, dollar yen, the 110, on euro dollar, the 111, okay, and on dollar Swiss franc, where are we? The dollar Swiss franc is still a bit far, but we can look at, I mean, 50 pips, 40 pips, it would be the 0.98 level, which is not bad, you know. And is 28, we have 2 minutes left, right? Let me just go and check quickly what's happening there. Sometimes the release is coming out before expectations, before expected, to be honest. Gold, Ahmad, gold is pretty much moving similarly to the dollar yen when we have the NFP. Well, euro is moving up, pound is moving up, dollar is moving down, but I'm not sure if the results are out yet. Let's have a quick look. I don't see them on any, okay, they are out, and they are bad. Okay, so as you can see, with a very, very quick view, and the first levels that they were reached were the ones that we've just drawn. So imagine if that was the entry over here, 110.96. We've taken out the 111.1 straight away, right? Dollar yen is falling over here, taking out the 109.54 straight away. Pound crossed above this level that we draw, and the dollar Swiss franc 97.43 already taken out. Now the question is, where is this going to stop, right? We never know, but judging from the results, and let me just actually take you there right now. So non-farm payrolls from 145. Okay, we are 23,000 below the forecast, and we are 111K below the previous report. The previous report was also revised downwards. However, it was only 10K. It's not really going to affect post-trading, let's say. Now, what is really, in my opinion, poor for this NFP is the fact that we actually crossed below the 3% on hourly earnings on a year-on-year basis. Okay, we talked about the CPI, of course, and I did highlight that this is not, we went to 2.1 CPI, right? This is not the PCE. PCE is the preferable measure from the Fed. So we see the pound moving, euro moving, okay, dollar is falling. Don't forget that the yen has been quite weak over the past few days, right? That is because we had the US/Iran tensions de-escalate, and a lot of yen outflows have caused weakness, of course, or strength in some currency pairs, depending on whether yen actually is denominated on it. Or we saw dollar yen was moving to the upside. Now the dollar Swiss franc is a little bit better, to be honest. I mean, Swiss franc seems to be a bit stronger than the yen. Now back to the results. Yeah, this is for me quite a bad result, to be honest. The 3.1, there was no revision here, which is okay. Now the hourly earnings on a month-to-month basis also went below expectations of 0.2, but at the same time they are also lower compared to the previous report. However, there is an upside revision in December from 0.2 to 0.3, right? So all in all, the results are not as good as one would expect to see, taking into consideration the seasonality effects from Christmas, of course, right? Who knows, maybe next month we're going to see an upward revision, but 150K, 45K, it's still not bad, right? It still shows that the job sector is growing in the US, however, at a pace that is softened, weaker than the economist expects. Now, let me quickly have a look at the next level for the euro dollar. Okay, so I'm probably looking at the 111.19, 111.20 as well. Don't forget, we always talk about the round levels, and the round levels are important. But I want to also remind you to not forget, when you set your stop losses or your take profits, always take into consideration the spread, okay? Price might get to the 111,200. That doesn't necessarily mean that you're going to take profit or your stop is going to be hit, because you still have the spread to consider, okay? So if, and the spreads are actually quite high during the NFP, if you have that in mind, I'm pretty sure that is going to help you decide on what your stop loss and what your take profit is going to be from now on. Okay, now dollar Swiss is doing okay. Dollar yen is, as I said, yen has been quite weak over the past few days, so for that reason is still falling. Now there is of course only 5 minutes passed since the release. Okay, we haven't seen much, to be honest, and the moves are not as big as we normally see during the NFP, right? So for example, let's just have a look at the price range of the euro dollar, right? I think, if I'm not mistaken, if we're 15 minutes down, so 30, that is the entry level, right? So we went up like 20 pips, right? This is not much for NFP. When we are talking about the NFP, we're looking at least like 40 pips, 50 pips, right? But if we just go back a little bit and remember what we were saying in one of the last slides, I said that if the divergence between the actual numbers and the projection, the estimates, are not bigger than 40, 50K, then we're not going to see big moves, right? Now, from the results, we were expecting 165, we came out at 145. This is 20K gap, right? It's not really much. So we moved a pip per 1,000, let's just say. The dollar yen seems to be recovering quite quick, but we might, of course, see the weakening taking place in the next 15 minutes or so. Dollar Swiss franc is doing better. Dollar Swiss franc moved. This is the entry price. It moved about 12 pips. I mean, one can even really consider if this is called a trade, to be honest, if it does make up a trade. Okay, pound dollar is doing like 33 pips, which is as we expected, right? We expected the pound to rise stronger compared to other currencies, because we did check the currency strength meter earlier, and pound was the best option to buy in a weak NFP scenario. And dollar with again yen is around the 12-13 pips, similarly to USD CHF. Okay, so the next level to look at now for the euro dollar, at least, and because there seems to be some resistance here, right? I would be looking at 111.15, 112.25, 20 or so, right? Now, if we're just going to analyze this a little bit more, right? Let's just go down on the 5 minutes. So here's what happened, right? We've done all those activity levels, we've drawn all of them, right? And we are down on the 5 minutes. So this is where the new candle opened, right? Now, assuming this is our entry level, right? Let me just do that long position from there. We could have our first target at the first level, which is pretty small, to be honest. It's like 9 pips or so. Yeah. However, you could just close like 80% of your size here or something like that. You could have successive take profit levels with the ones that are closest, of course, to be reached, the ones with a lower range from the entry price weighing the most. So you could close like, say, 80%, 50% of your trade over the first level, and then another 50% over the second level, right? You would, you would get 17 pips on the one trade, and then another 9 pips on the other trade. Still, this is 2 trades. If you add them up, you're making about 25, 30 pips, which is still a winner, right? And of course, your stop in this case would be below this previous level, right? So around 10 pips in this case will still makes a good scenario of a good risk to reward ratio. Not as good, but for at least for NFP is not bad, right? Let me just delete that. Now, we could do the same for the pound, since we actually went for the pound today. Let's just see how this would play out, right? So our level here is 130.80, right? But you can see we're still far away from the first target, okay? Don't forget this, that we did do indeed 30 pips. But when we look at the entry price, right, we haven't even reached target yet. So that's why it's very important to always pay attention to how far is the current price from your entry level, right? Because the truth is, you have to really set, if you set a pending order, then it has to be something like that, right? And if you set a pending order, this would be triggered. It would open, you will probably be up here anyway because of the spread, and we're looking at 131 anyway, right? So, does it really worth the risk? You may want to ask yourself. For the particular structure, market structure, I don't think it does, to be honest. On euro dollar, it's a different case, yes, because we have a very good entry level up here, okay, and the next level that we have is not far from being reached anyway. But on pound, we're going from 130.80 to 131.15, okay, and this is like 31, 32 pips higher than the entry level. So, you can really see that as a bad opportunity, to be honest, okay. Now the rest, dollar yen, as I said, it's been quite weak, the yen, so I wouldn't really look at it as an opportunity to sell. The opportunity for a weak NFP, the best one would be again the GBP USD. But also, if you remember, when we talked about yield differentials, we talked about dollar CAD, right? So in case that nothing makes sense from a technical perspective or from a strength perspective, then this is when we can turn to yield differentials. So why don't we have a quick look on dollar CAD as well? And here you see a good range, right? Because CAD, the Bank of Canada has the same interest rates as in the US, okay? Okay, so let me just see that one potentially. Okay, so with closed eyes, we can say that this would be a very good entry price, right? Entry level. The stop loss will be just a little bit above this previous high. So, and then we need to look at the next level, which is, okay, I would say with closed eyes, but my eyes are open. So, but it's very easy to set that as a first take profit level. And the second one would be down here, right? Now, let's look at this potential opportunity. How would that have reflected in our accounts potentially, right? So let's go for a short over here. Entry price would be there. Okay, our first take profit would be over here, which is some 12, 13 pips or so, okay? Stop loss would be, this is 76, so let's go a little bit higher. Let's go to the 800s, okay. First target would be here, second target is here, right? So we are talking about 1.27 risk to reward ratio, which isn't bad, okay. Now the question is, I mean, we're not there yet. Actually, let me just get that one over here as well, because this is a higher activity level, okay. So our risk to reward is 1.2 over here, right? So we haven't reached target 2 yet, but if you ask me, the first trade would be over here, okay. Then that is being closed out, and the moment this trade is closed out, you leave that trade open and you move your stop loss over here, okay. This is for break even. So in case you don't get the second target reached, at least you're closing at break even and you are pocketing the first trade into your account, right? Now, if we look at this, we're looking at 130.26 or so. So 25 is a good psychological level, to be honest. We are currently at 130.30, but I do think this is going to be taken out anyway in the next few minutes, or even in the next few hours. Now, the thing is, there was a mention for those who are still not confident that they can trade the NFP properly, or at least with covering, let's just say, being able to manage risk. So for those, we talked about post NFP trading, right? This one option, of course, is to open a trade immediately after the results come out, but it's not recommended because we still have a lot of volatility. The other one is to wait for at least half an hour, maybe even an hour, until you receive some sort of good reversal signal, right? But this is completely different to price action, okay? We're not trading here price action, we're trading a reversal. And this is usually called, I mean, on the upside and price is moving down, which is what we see currently on euro dollar, that would be called something like a hummingbird or a tweeter, or whatever you want to call it. On the downside is the very famous strategy that is called dead cat bounce, right? So in this scenario, for example, I mean, we can't really call that a dead cat bounce over here, because the truth is that it's not really a dead cat bounce. In this scenario, dollar cat, actually, it would be a much better scenario, because prices have moved already once down, and then we had a correction, and then it moved it again down now as we currently speak, because of the NFP. Whereas in this case, we're not really looking at dead cat bounce, because prices have just actually reached a high a few hours back. So I wouldn't see that with a similar eye. Now over here, let's just assume that we want to trade the dead cat bounce, right? So what will happen in this case? This would be the entry price, right? And if that is the entry price, then that means that we really want to see where exactly prices are going to be retracing back to, right? And we have to take the beginning of the candle, okay, of this candle, which is the 30-minute time frame, and go down to the expected level, right, which is the 130.26, for example, in the dollar card case. What we're gonna do, we're gonna include the 0, the 1, and the 0.5. This is the 50 Fibonacci extension. And coincidentally, this is exactly the same level as the one we have drawn over here, okay, which is a bit shy of the 1.3050, which makes sense, because you'll see a lot of times that a weak attempt to reach some level, right, it means that there's not many orders on that psychological level. So at 130.50, which is over here, okay, there's not many orders, okay. That's why we see this gap over here. So the orders are here, which means that potentially on the downside at least there isn't much on the 130.50. It could be the case where there is a lot of buy orders, but of course we'll be able to see that only after prices have come a little bit higher. Now, in this case, just going back to the trade we were looking at, we would be looking at the 50 Fibonacci retracement, right? So the entry price, let's go for a long in this scenario. The entry price would be over here. The exit would be at the 0.5, and of course on the downside, because we're not really expecting, we may want to add a fixed amount like 10 pips or something, right? To the downside. So that would be a call, that would be a buy option, and we'll make 18 pips and risking only 10 pips. So still very good risk to reward ratio in this scenario. But don't really rush into that. We said we can set a pending order over here. That would be the best solution, to be honest. Okay, you have a very small 10 pip risk, which is, I'm pretty sure everybody can risk 10 pips. But you have to really pay attention at your lot size, of course, right? So don't go crazy. Keep 1%, 2%, maybe even 3% maximum per trade. For your 10 pips, for example, you would want to do, you don't want that to equate, for example, like $3 per pip or something like that, okay? When we look at the per pip value. And on the upside, you would make, for example, 1.8 times that. Now, that being said, the time is 3:51. There is 9 minutes for the hourly candle to close, right? So when we talk about this particular dead cat bounce strategy, we want to look at the 1 hour chart, right? And at the same time, since we are really looking at retracement levels and potential levels that prices may might go down to or up to, then it might be also a very good idea, since we are down here, right, to draw a Fibonacci retracement over here, right? Because what we'll be able to see is that this is exactly the 50 Fibonacci retracement, right? And what does this mean? This means that we were looking at entering the 132.50, right, which is a tad below the 50 Fibonacci retracement. So when you're really looking at your entry level, it's not really necessarily to look at the level that we've just talked about, which is down here, right? If you know that this is a 50 Fibonacci retracement, then you may want to move your entry a little bit higher. Okay, now I'm just saying because there is some things that we need to consider when we are constructing our charts. Okay, and of course when trading, we need to look at what's happened in the past to be able to know or have at least somewhat accurate evaluation of future price structure. Okay. Now, with that being said, the second Fibonacci I want to do this other move to the upside, right, which is over here. Okay, so in that case, I see also that the 61.8 Fibonacci extension, Fibonacci retracement. Sorry, let me just get that over to the last. The 61 point, the golden ratio here comes out to about the same level, 130.26. So you do know that this is a very good level, right? To start, for some orders to take effect pretty much, right? Now, since we are on a big drop over here, we do know that at this level, someone will start taking profits, right? Because they need to take profits. So naturally speaking, it will have a bounce effect on prices, right? And we're looking probably to come up here. Now, the moment we come up here, right, this is the level that we can close our trades and be safe. We've pocketed some trades, and that's it. Now, from there, there is two things that can happen, right? One, we'll move down, okay, continuing the initial NFP related sentiment, or we could move higher, okay? Now, this higher can be that level, oops, 1 second, or many times, and you will be able to notice that for yourself as well if you go back and check what's happening in history. Many times you will see prices retracing back to this exact level, okay? This candle, my friends, is called a high momentum candle, right? Obviously, these candles are not only formed during the NFP. You will see candles like these formed in other different times as well. Now, anything that is above 15, 20 pips, I would say it's a high momentum candle, even above 10. Now, this high momentum candle had an entry price over here. So we could see if prices go back up, and if we break above this level, the 130.56, we are going to hit that like there's very good chances. Obviously, this is not really you know, a good trade for someone who's trading maybe intraday, maybe a scalper or something. You know, this is like 7-10 pips, so for some may not really be ideal, but just in case, know that in case we get a bounce over here, a test, then we could see prices, instead of bouncing over here and going down, we could see that bounce taking price lower up here, right? Now, in case we break above that level, right, we're most likely gonna go above that one as well, right? And in that case, because we don't really see any high momentum candles over here, at least on the 1 hour, right? It means that the next level to look at would be this one, okay? We didn't have high momentum candle, right? But we did have a number of bearish candles, okay? Which means, I mean, if we go down on the daily or on the 4 hour, this is a very good momentum candle on that term, right? So you can see that over here, you see? But if we look at the 4 hours, what we want to do as well is we want to add this very nice activity level over here as well. And then if we go back on the 1 hour, this is the two levels that we want to look at, right? Now, this, because we have an upside move, right? And we are really expecting prices to potentially start moving lower here, if there is a bounce, of course, over here, right? Then this is the tricky bit, usually, right? Because this area over here, could indeed cause a bounce. We could see prices moving above that level, coming over here, creating a double top, yeah, and then moving lower. Or the other scenario, which is the most tricky one, prices cross above that level, everybody starts buying because they think, well, we've crossed above this level, now it's a breakout, and then prices move below. So in that scenario, what I want to do, I want to see a retest over here. If this level holds, then this could be seen as a move to the upside. If this level breaks, then we could look at this one first, then second, third, and this is pretty much how the markets are moving. Now there is 2 minutes left for the candle to close. You are seeing over here that most of these move on the euro dollar, the dollar Swiss franc, or the pound, they have been really, they really reversed, all of them, okay? And they went back to the entry price. As we said, this is a high momentum candle, okay, and prices reversed all the way back. The only one that is really holding, right? Let's go back on the 15 minutes, or the 30 actually, is the dollar CAD, okay? And we did identify the reason for that, because when we look at interest rate differentials, then the Canadian dollar is the one that is the strongest against than the dollar. So when all relationships break, look at the differentials between interest rates. So I hope you are able to take notes, to make some good trades if you did. I hope that was helpful for you. And I want to thank you, of course, for watching our monthly NFP. In case you have questions, I've already provided you with my handles for Twitter and LinkedIn. Feel free to send me any questions related to the NFP. And of course, you also should be able to find a lot of content on our blog. We'll cover all topics there, fundamentals, technicals, to help you, of course, improve your trading skills reasonably. Have a nice weekend all, and I'll see you again on Monday on our daily Market Insights video.